Imagine. You worked hard for years. You worked from morning till night. You saved a little money every month. And then one day someone said, "Brother, invest in the stock market. Money will make money itself." You also thought, if everyone is doing it, why shouldn't I? You bought a share on the first day. The price went up a little on the second day. Your heart was happy. You thought, I am a smart investor. But then, one day the market fell. Your share turned red, was showing a loss. The loss started increasing, and at that moment a voice came in your head. What should I do now? Should I sell or wait? This is the question, to find the answer to which the world's greatest investment book was written. The Intelligent Investor. The author of this book, Benjamin Graham, is called the father of value investing by the world. Benjamin Graham did not write this book for those who want to become rich overnight. He wrote this book for those who want to stay rich all their lives. The book begins with a bitter truth. Graham says, most people do not come to the stock market to invest, they come to gamble. They call themselves an investor, but in reality, they are a speculator. And right here, the book explains the most important difference. What is investment and what is speculation? According to Benjamin Graham, investment is that which has three things. 1. Thorough research and analysis. 2. Safety of principle. 3. Expectation of a satisfactory return. If even one of these three things is missing, then it is not investment, it is speculation. That is, if you bought a share without understanding, on a friend's tip on the basis of some news, or just seeing the price increase, then you are not investing, you are gambling. Graham says clearly, the market can make you rich, but first, it tests you. And right here, the book gives an extremely powerful example, which is the soul of this entire book. The story of Mr. Market. Benjamin Graham creates a fictional character to explain the market, Mr. Market. Suppose you and Mr. Market are partners in a business. Every day, Mr. Market comes to your doorstep and says, "Today I want to buy or sell my share at this price." But the problem is that Mr. Market is very emotional. Sometimes he is very happy, and he quotes a very high price for the business. And sometimes he is very scared, and he starts selling the same business at a very cheap price. Benjamin Graham says, Mr. Market's biggest mistake is that he changes his mood every day, and most investors change their decisions with that mood. When Mr. Market is scared, the investor also gets scared. When Mr. Market gets greedy, the investor also gets greedy. But the intelligent investor does not do this. The sensible investor knows, Mr. Market is for my help, not for making my decisions. If Mr. Market wants to buy my shares at a very high price, then I think, perhaps it is time to sell now. And if Mr. Market is selling very cheaply out of fear, then I think, this could be an opportunity to buy. Graham says, do not make the market your master, make it your servant. Share price versus company value. Now the book explains another very profound thing. The price of a share and the intrinsic value of the company are not the same. The market, in the short term, runs on emotions. News, fear, greed, rumor, all shake the price. But the real value of the company is determined by its business, profit, assets, and future potential. Graham says, if you only look at the price, you cannot become an investor. You have to understand, you are not buying a share, you are buying a piece of the business. Inflation and the investor's mindset. The book also explains that inflation is the biggest enemy of your money. If your money is just lying in a savings account, even if it looks safe, its real value gradually decreases. Therefore, Graham believes investment is necessary, but investment done wisely. Wrong investment can be more dangerous than inflation. In this first part, Benjamin Graham teaches us, every share is not an investment. Every profit is not wisdom. The market runs on emotions. And the biggest enemy is the investor's own emotions. From here, the paths of a common man and the intelligent investor diverge. Now pause and think. If every person comes to the stock market, should every person invest in the same way? Benjamin Graham says, absolutely not. This is the place where most people make the biggest mistake. They want to be like others without understanding who they are. Therefore, in the book, Graham divides investors into two parts, defensive investor and enterprising investor. Understanding this difference is the key to understanding the entire book. The defensive investor is the person who does not want to make the stock market their whole life. They have limited time, who cannot read a balance sheet every day, who is afraid of volatility, and who most wants a peaceful sleep. Benjamin Graham says if you are a defensive investor, you should not try to beat the market. Your goal should be to move forward safely, along with the market. For the defensive investor, Graham gives very clear rules. He says, such an investor should only invest money in companies that are large and established, whose business has been running for years, whose earnings are stable, and who have shown profit even in difficult times. Graham believes small or new companies might give more returns, but they are full of danger for the defensive investor. Here, Graham says a very important thing. The greed to increase returns often destroys safety. For the defensive investor, dividend is also very important. Why? Because a dividend proves that the company is genuinely making money, not just on paper. Graham says, a company that has been giving regular dividends for years, its business is often strong. Now comes the matter of price. The defensive investor never buys any share at a very expensive price, even if the whole world says, this company is the future. Graham clearly says, even a good company bought at the wrong price becomes a bad investment. The enterprising investor. From here, the book slowly moves towards the second type of investor. Now comes the enterprising investor. The enterprising investor is one who does not just want to stay safe but wants to earn extra returns by putting in extra effort. But Graham gives the strongest warning here. He says becoming an enterprising investor sounds very attractive, but in reality, this path is very difficult. This is the investor who reads the company's balance sheets, understands their debt, checks the stability of profits, and looks for market mistakes. Graham says, if you cannot do all this, trying to become enterprising can harm you. There is a strict warning in the book. Being more active is not always being more intelligent. Most people in the pursuit of becoming enterprising investors end up becoming speculators. They think, I am smart, I am faster than the market. But Graham says trying to beat the market often turns into losing to the market. From here, the book moves towards a very important principle, the illusion of risk and return. People believe more risk equals more profit. But Graham says, this is half the truth. In reality, unnecessary risk often leads to loss. The true enterprising investor does not increase risk. He looks for mispricing. He searches for those companies that have become cheap in the market due to temporary problems. But even here, Graham says, if you do not have patience, this strategy can break you because the market does not agree with you quickly. Sometimes, despite being right, you might look wrong for a long time. And from here, Benjamin Graham talks about the investor's psychology. He says, the hardest thing is not finding a company, it is sticking to your conviction. If you get scared by every market fluctuation, you will remain neither defensive nor enterprising. So Graham says, first decide who you are. If you are defensive, be proud. If you are enterprising, work hard honestly, but do not imitate anyone else. Summary of this part. Every investor is not the same. Choosing the wrong category is the biggest loss. Hard work without understanding is not beneficial. And real investing starts with knowing yourself. Now the book arrives at a principle without which, according to Benjamin Graham, investment cannot be called safe at all. This principle is margin of safety. Graham says, if you have to remember only one thing about investment, it should be this. Margin of safety means buying a share at a price significantly lower than its intrinsic value. But now the question arises, what is intrinsic value? Benjamin Graham explains, the share price is what the market shows every second. But the company's value is determined by its business, its earnings, its assets, and its future potential. The market often mixes these two up. Sometimes due to emotions, the price goes very high, and sometimes due to fear, it falls very low. The intelligent investor plays here. He waits. He buys when the market is in fear, when newspapers are negative, when people are saying nothing will be left now. Graham says, if you have bought with a margin of safety, you do not need to be perfect. Even a small mistake of yours will not be able to sink you. This is the reason that investing without a margin of safety becomes speculation. Now the book talks about emotions. Graham clearly says, the investor's biggest enemy is not the market, it is himself. Fear and greed force the investor to make wrong decisions repeatedly. When the market goes up, people buy because they do not want to be left behind. And when the market falls, people sell because they are afraid of more losses. But the intelligent investor does not become part of the crowd. He thinks, if I am selling today, why is the person opposite me buying? Graham says, the market, in the short term, is a voting machine. It runs on emotions, but in the long term, it is a weighing machine. It weighs the real value. Therefore, the investor who gets scared by the daily fluctuations can never enjoy the full benefit of the long term. Now the book explains another important thing, volatility. Most people believe more fluctuations mean more risk, but Graham says volatility itself is not risk. Volatility is dangerous only when you misunderstand it. If you have a strong company and you bought it at the right price, then a fall is not a threat to you, it is an opportunity. Graham says a very strict thing here. If a market fall does not let you sleep at night, then you have either bought the wrong share or at the wrong price. Now the book comes to diversification. Graham believes diversification is necessary to protect the capital, but he is against blind diversification. Buying every company is not wisdom. Diversification means spreading the risk, not the ignorance. The sensible investor puts money in a few selected, understandable companies. Now the book talks about patience. Graham says, in investment, time is your friend. But if you are in a hurry, the same time will become your enemy. Most investors select the right company, but sell at the wrong time. They take the profit too quickly and hold on to the loss for a long time. The intelligent investor changes this inverted thinking. He lets the profit grow and identifies the mistake quickly. Graham says, the stock market slowly takes away the money of impatient people from patient people. Here the book explains another important point: forecasting. Graham clearly says accurate prediction of the future is not possible for anyone. The investor who tries to predict the future often ignores the present. The intelligent investor does not predict the future. He looks for a margin of safety in the current price. Summary of this part: margin of safety is the soul of investment. Emotions are the biggest weakness of the investor. Volatility can be an opportunity, not a threat. And patience is the biggest weapon. Now look back. In this entire journey, Benjamin Graham did not give you any magical formula. He did not reveal any secret that would make you rich overnight. And this is the biggest truth of this book. The intelligent investor does not teach you how to snatch money from the market, but it teaches you how to save yourself. Graham says, the real purpose of investment is not to beat the market, but to avoid your own mistakes. Now the book comes to a final but most important point: the investor's mindset. The intelligent investor is not one who is active all the time. He is one who does the right thing at the right time and remains calm the rest of the time. Graham clearly says, in investment, wisdom is not in quick decisions, it is in discipline. Now the book explains the power of the long term. The market never moves in a straight line. It falls in between, scares and disappoints. But over time, strong businesses only go up. The investor who runs away at every decline can never taste the full fruit of this journey. Graham says, the investor who bases his decisions on books and logic remains safe from the noise. Now the book gives a final warning against speculation. Speculation is not dangerous when you know that you are gambling. It is dangerous when you start considering gambling as investment. The intelligent investor never gives the name of investment to speculation. He can take risks but not blind risks. Now Graham gives the final word on the relationship between dividend and investor. A dividend is not just money, but a sign of discipline. It shows that the company respects its owners. In the long term, the dividend rewards the investor's patience. Now the book says a truth that every investor understands sooner or later. The market can take a long time to agree with you. You might be right, but alone, and this is where most people break. But the intelligent investor does not seek the crowd's approval. He seeks logic's approval. Graham says success in investment does not mean always being right, but persevering for a long time. Now the book gives its final message. If you can control your emotions, can buy with a margin of safety, can maintain patience, and can understand yourself, then the market will not remain your enemy. It will become your opportunity. This is why Warren Buffett says, this is by far the best book on investing ever written. This book does not change the numbers, it changes the mind. And when the mind changes, the decisions change. And when the decisions change, the results change. If you truly adopt the mindset of this book, you will not just remain an investor, you will become an intelligent investor. So today you have not just heard the summary of a book. Today you have learned an investment mindset. Benjamin Graham did not teach us how to snatch money from the market. He taught us how to save ourselves. Because the real investor is not one who buys and sells every day. The real investor is one who knows how to remain calm. At the right time, the market will scare you, tempt you, and sometimes leave you alone. But if you hold on to margin of safety, patience, and discipline, then time will become your biggest ally. Remember, the market is conquered not with a quick mind, but with a cool mind. If this video has brought even a slight change in your thinking, then do not consider it an investment. Consider it a small beginning of your future. If you liked the video, like it, subscribe, and take this mindset to those people who truly want to learn. We will meet in the next video with a new book, a new understanding, and a better mindset. Until then, remember, fight your own mistakes, not the market.